The Wall Street crash of 1929, also known as the Great Crash, was a stock market crash that occurred on October 29, 1929. It is widely considered to be the most devastating financial crisis in American history and one of the most significant events of the 20th century. The crash led to the Great Depression, a period of economic hardship that lasted for over a decade and had a profound effect on the global economy. The 1920s were a time of prosperity and optimism in the United States. The economy was growing rapidly and many people were investing in the stock market, which had seen tremendous growth in recent years. However, this growth was not sustainable and was fueled by speculation and insider trading. In addition, many companies were overvalued and had weak fundamentals. In the months leading up to the crash, there were warning signs that the market was overheating. In August 1929, the Federal Reserve raised interest rates to try to cool down the economy, but this had the opposite effect. The stock market continued to rise, and by the end of September, the Dow Jones Industrial Average had reached an all-time high of 381.17. On October 24, 1929, the market began to decline. This decline accelerated over the next few days, and on October 29, the market experienced a panic sell-off. In a single day, the Dow Jones Industrial Average lost 12.8% of its value, and by the end of November, it had lost a total of 40%. This was the start of the Great Depression, a period of economic hardship that lasted for over a decade. The crash had a ripple effect throughout the economy. Many banks and businesses went bankrupt, and unemployment rose dramatically. Consumer spending and investment dropped, and the economy contracted. The Great Depression was a global phenomenon and affected many countries around the world. The Wall Street crash of 1929 is widely considered to be one of the most significant events of the 20th century. It had a profound effect on the global economy and led to a period of economic hardship that lasted for over a decade. The crash serves as an important lesson for investors and policymakers, and highlights the importance of maintaining economic stability and avoiding excessive speculation. The causes of the crash are many and complex, but some of the most important factors include speculation and insider trading. Many people were buying stocks on margin, which means they were borrowing money to buy stocks. This increased demand for stocks and pushed up prices, but when the market began to decline, many people were unable to pay back their loans and were forced to sell their stocks. This led to a panic sell-off. Overvaluation of stocks. Many companies were overvalued and had weak fundamentals. This meant that their stock prices were not based on their actual value, but on speculation. When the market began to decline, many people realized that the stocks they had bought were not worth as much as they thought, and this led to a panic sell-off. Lack of regulation. There was very little regulation of the stock market in the 1920s, which allowed for insider trading and other forms of market manipulation. This contributed to the overvaluation of stocks and the market crash. The Federal Reserve's monetary policy. The Federal Reserve raised interest rates in August 1929 to try to cool down the economy, but this had the opposite effect. The higher interest rates made it more expensive to borrow money, which reduced demand for stocks and led to a decline in the market. The Great Depression was a severe economic downturn that lasted for over a decade and had a profound effect on the global economy. In the United States, unemployment rose dramatically, and many banks and businesses went bankrupt. Consumer